All right, folks, welcome back to Fin Quiz. If you've made it through part one, congratulations. You've already built the foundation of modern portfolio theory. You learned how diversification shapes risk, how correlations drive efficiency, and how the capital allocation line changes the whole investing landscape. Now, in part two, we're leveling up. This is where theory starts to meet real investing, where all those curves and lines we learned in the last section actually connect to how investors earn returns in the real world. So, what's the big question this module answers? It's simple but powerful. If I take on more risk, how much extra return should I expect? That's the essence of capital market theory. And yeah, the CFA exam loves this question. In this module, we're going to walk through it step by step. First, we'll blend risk-free and risky assets and see how that changes the shape of the investment opportunity set. Then we'll meet the capital market line, CML, the big upgrade to our old efficient frontier. After that, we'll break down systematic and non-systematic risk, how beta captures market sensitivity, and how we price risk using the CAPM, or known as CAPM. And finally, we'll wrap up with performance measures like the Sharpe, Treynor, and Jensen's alpha, and how CAPM ties into real-world portfolio construction. So yeah, we'll move from abstract frontiers to how actual investors, you, me, portfolio managers, use models to decide what's a fair return for a given level of risk. Now remember this from part one, and this is key for the exam. Not all risk gets rewarded. You only earn a premium for systematic risk, the kind you can't diversify away. The rest, that's just noise. All right, let's get rolling. Capital market theory, risk-free and risky assets. So let's pick it up from where we left off. Remember? In part one, we learned how mixing risky assets gives us that curved shape, the efficient frontier. But in real life, most investors don't hold only risky assets. They've also got something risk-free, like treasury bills or short-term government notes. And once you throw that risk-free piece into the mix, the whole game changes. Let's start with what a risk-free asset really means. It's an investment with zero standard deviation, no uncertainty in return. You put in $1, you know exactly what's coming back. Now, sure, nothing in the real world is perfectly risk-free, but for CFA exam purposes, we treat short-term government securities as close enough. Plot that on our usual graph. Risk on the x-axis, return on the y-axis. That risk-free point sits right on the y-axis because it has zero risk. Now, if you connect that risk-free rate to any portfolio of risky assets on the efficient frontier, you get a straight line. And this straight line, that's our capital allocation line, or CAL. This line is powerful because it shows every possible risk-return combo you can get by mixing the risk-free asset with a particular risky portfolio. But here's the catch. Not all CALs are created equal. You can draw a CAL through one risky portfolio or another, but the best one, the one with the steepest slope, is tangent to the efficient frontier. That tangency point is what we call the optimal risky portfolio. Now, mathematically, the slope of that line is the Sharpe Ratio, the measure of how much extra return you earn for each unit of risk. So when someone says this portfolio has a higher Sharpe, what they're really saying is, I'm squeezing more return out of each bit of volatility. Now, what it really says, the steeper the slope, the better the deal between risk and return. And here's a quick exam trap. If two CALs appear on the same graph, the steeper one always dominates. It's more efficient because it offers more return for the same amount of risk. So, yeah, that's the heart of capital market theory. Once we add a risk-free asset, the old curved frontier turns into a straight line, and investors can simply pick any point along that line based on how much risk they're comfortable taking. All right, so before we jump into the capital market line, let's make one thing super clear. When we mix a risk-free asset with a portfolio of risky assets, whether it's 2, 10, or 100 stocks, the math doesn't change, just the size of the equation. The portfolio's expected return is basically the weighted average of the individual returns. And the risk? That depends on how those assets move together, their covariance. Now here's where things get interesting. If all investors share homogeneous expectations, meaning they all believe in the same risk and return assumptions, then everyone ends up choosing the same optimal risky portfolio. And that special portfolio is called the market portfolio. Once that happens, the capital allocation line through this market portfolio becomes the capital market line, the version of CAL that applies to the entire market. Of course, in the real world, investors don't agree perfectly. Some think Apple's overpriced, others think it's cheap. But when you put all those views together, prices settle where the marginal investor, the one at the edge of buying or selling, finds the balance. And that's what shapes market prices and the CML we use in theory. Now let's make this real. Imagine two fund managers. One runs a US tech fund that's super volatile but earns strong returns. The other runs a balanced fund that mixes stocks and government bonds. When we plot both, the tech fund's line might be flatter. Big swings, but not enough reward per unit of risk. The balanced fund's line, steeper, less drama, better efficiency. And that's what investors really care about, not just returns, but returns adjusted for risk. So here's the key exam insight. You can draw a CAL through any risky portfolio, but the best one, or the one that touches the efficient frontier at just one point, is the tangent line. That's your optimal capital allocation line, and the point of tangency is the optimal risky portfolio. It's the sweet spot where you can't improve the risk-return trade-off any further. Anything below that line is inefficient, and anything above it is impossible. And that's the core of capital market theory. Once we add a risk-free asset, the efficient frontier isn't a curve anymore. It's a straight line. And that line gives investors the freedom to pick a portfolio that matches their personal appetite for risk. A conservative investor might be near the left, heavy in T-bills, light on stocks. A more aggressive one might be far to the right, even borrowing at the risk-free rate to take on more of the risky portfolio. But every rational investor stays somewhere on that line. All right, so that's the setup. Next, we're going to expand this idea into something even more universal. The capital market line, which applies to the entire market portfolio. That's where the real fun starts. Now, think of the capital market line, the version of CAL that represents the entire market portfolio. All right, so once all investors start using the same information and have the same expectations, what we call homogeneous expectations, everyone ends up picking the same risky portfolio. And that special one, that's called the market portfolio. Now, the capital allocation line that runs through this market portfolio becomes something even more famous. It's called the capital market line, or CML. So yeah, the CML is basically the supercharged version of CAL. It shows all possible combinations of the risk-free asset and the market portfolio. Here's how to think of it. Every point on the CML represents a different investor's mix between the risk-free asset and the market portfolio. As we discussed earlier, conservative investors, they stick to the left side, mostly in T-bills, a little in the market. Moderate investors, they're somewhere in the middle, maybe 60% in stocks, 40% in risk-free. Risk takers, they're way out on the right, even borrowing at the risk-free rate to invest more than 100% in the market portfolio. The CML, in short, gives everyone the same efficient path. It's just your position on the line that changes with your risk tolerance. Now, investors can either go passive or active on this. A passive investor simply tracks the market, like buying the S&P 500 or a global index fund. No predictions, no fancy moves, just low-cost exposure to the market portfolio. An active investor, on the other hand, tries to beat that market through research, security selection, or timing. But remember, in the CFA world, it's assumed that markets are efficient. So on average, most people don't beat the market. So what exactly do we mean by the market here? In theory, it includes everything that has investable value: stocks, bonds, real estate, commodities, even human capital. But in practice, we use something like the S&P 500 as a proxy. It covers about 80% of the U.S. equity market. On a global scale, stocks make up roughly 1/3 of all investable wealth. So the market portfolio is really broad and diversified. Now, this is the equation for the capital market line. The expected return on the portfolio equals the risk-free rate plus the market's excess return per unit of risk. That's the Sharpe Ratio, multiplied by the portfolio's standard deviation. So basically, it's the same idea as the CAL, except now the risky asset isn't some random portfolio, it's the market portfolio, the big all-in-one basket that includes everything: stocks, bonds, real estate, commodities, the entire investable universe. Think of the S&P 500 as a rough proxy for the market portfolio. If the risk-free rate is 3% and the expected return on the S&P 500 is 9%, then the slope of your CML, your Sharpe ratio, is 9 minus 3. Divided by 15, it would be 0.4. That means for every 1% of additional risk, you expect 0.4% of extra return. Now, this 15 number is the market risk that we assumed here. So if you take on, say, 10% standard deviation in your portfolio, your expected return is 3% plus 0.4 times 10, which equals 7%. Simple, right? That's how you can translate the math into intuition. The CML gives you a clean, linear trade-off between risk and reward. Now, when your portfolio is partly in T-bills and partly in the market, you're on the left side of the line. That's called lending. When you're fully in the market portfolio, you're at that tangent point. And when you borrow to invest more than 100% in the market, that's called leveraging, you move to the right side of the line. Now, here's something examiners love to test: the implication. More leverage means higher expected return, yes, but also higher risk. And if borrowing costs are higher than the risk-free rate, that line starts to flatten a bit. The slope decreases because you're paying more to take on that leverage. So the takeaway: the CML gives you the best possible combinations of the market portfolio and the risk-free asset. Everything below it is suboptimal. Everything above it, well, that's not achievable in reality. Now, here's your exam tip, folks. Don't confuse the capital market line CML with the security market line SML. The CML plots portfolios. combinations of the risk-free asset and the market portfolio, whereas the SML plots individual securities. You'll see that in the next learning module, but just remember this hint. CML equals portfolios, SML equals individual assets. All right, let's circle back to the big takeaway here. The CML dominates all other possible lines. Nothing lies above it. If it did, it would mean a free lunch, which, yeah, doesn't exist in finance. And anything below it is suboptimal. You're getting less return for more risk. That's why, in theory, every rational investor, from Warren Buffett to a student just starting a savings plan, should be somewhere on that line. Not above it, not below it. On it. And hey, the visual you're seeing on screen, that's right out of our FinQuiz Battle Ready summary. Notice how it lines up everything clearly. The risk-free rate, the tangent point, the slope. So when you get to a tricky CFA question, you can literally visualize the graph in your head. If you're prepping for the exam, grab the Battle Ready summaries from the link in the description. They're made for quick visual recall, just like what you're seeing here. And if you want the full FinQuiz experience, we've got the Stanley Notes, the question bank, mock exams, and the formula sheet, all built to reinforce each other. You'll never need to guess what to study next. We've already structured it for you. All right, so now we're taking the capital market line one step further into the world of leverage. So far, we've stayed between the risk-free asset and the market portfolio. That's the lending zone. You mix T-bills with the market portfolio to control your risk. But what if you're feeling confident, maybe even a little bold? Well, you can step beyond the market portfolio, and that's where leverage portfolios come in. So let's unpack this one carefully, because this is where portfolio theory starts to feel a bit more real world. So far, we've looked at the capital market line as a clean, straight line between the risk-free rate and the market portfolio. But now we're going beyond that. We're talking about what happens when you borrow money to invest more than your own wealth. And that, my friend, is called leverage. Let's start from the basics. At the far left of the CML, you've got your risk-free investment. That's when 100% of your wealth is in secure, risk-free assets, like treasury bills. No surprises, no volatility, just a steady, guaranteed return at risk-free. Now, move up along the line to point M. That's the market portfolio. Here, your entire wealth is in the market. No lending, no borrowing. You're fully exposed to market risk and return. Between risk-free point and M, that's your lending zone. Investors here mix a bit of the risk-free asset with the market portfolio. Think of it like if you've got $100, you might put $70 in the market and $30 in T-bills. You're lowering risk by lending part of your wealth at the risk-free rate. But once you move beyond M, something big changes. Now you're entering the borrowing zone. This is where investors start taking on higher risk by borrowing money to invest more than 100% in the market. So instead of $100, you might borrow another $50 and invest $150 in the market. That's a leverage portfolio. And yeah, your potential returns rise, but so does your risk. The line on the CML beyond M represents these higher risk leverage strategies. Now, your personal risk aversion determines where you fall on this line. If you're conservative, you'll stay to the left. More T-bills, less market. If you're moderate, you'll hang out near point M, 100% in the market. And if you're risk-loving, you'll move beyond M, borrowing to boost returns. But here's the problem. In the real world, borrowing isn't free. You can lend at the risk-free rate, sure, but you'll probably borrow at a higher rate, say RB. That small difference changes the slope of the line, meaning your portfolio return equals the risk-free rate plus the market's extra return per unit of risk, multiplied by your portfolio's risk. But once you start borrowing, your expected return now starts from a higher borrowing rate and rises more slowly because part of your gain goes into paying interest. That's why the CML forms a kink at point M, two different slopes, a steeper one for lending portfolios and a flatter one for borrowing portfolios. And this little kink, it's exactly what CFA examiners love to ask about. So make sure you remember, the kink in the CML happens when borrowing and lending rates differ. Let's use a real example, the one with Mr. Miles from the curriculum. He's already been investing somewhere between T-bills and the market. At 100% in T-bills, he's completely risk-free. He's lending his entire wealth at the risk-free rate. At point M, he's 100% in the market portfolio. No lending, no borrowing. Now, all the portfolios between R, F, and M are lending portfolios. Lower risk, lower return, and pretty conservative. But what if Mr. Miles wants more return? Even if that means taking on more risk. He can move to the right of the market portfolio, meaning he borrows money at the same risk-free rate and invests more than 100% in the market. That's what we call a borrowing portfolio, or simply a leverage position. So let's say the risk-free rate is 5%, the expected market return is 15%, and the market standard deviation, or risk, is 20%. All right, let's throw in some numbers because you know the exam loves this stuff. But before we jump into the numbers, remember the basic weighted return formula, that the expected portfolio return is simply the weighted average of the returns on each asset. Yep, that's what we're going to use here. Okay, now back to Mr. Miles. Now picture this. Our good friend Mr. Miles decides he wants to boost his returns. He borrows 25% of his own wealth and invests 125% in the market portfolio. So how do we calculate his return? In our case, that means one weight for the risk-free asset and another for the market portfolio. When leverage comes in one of those weights, the market becomes greater than 1. While the risk-free weight becomes negative. That negative portion just means you're borrowing at the risk-free rate instead of lending. So we'll use 5% times negative 0.25. That's the borrowing part. Plus 15% times 1.25. That's his total exposure to the market. Do the math and you'll get 17.5% as his expected return. Now what about his risk? Well, his risk goes up in proportion to how much he's investing in the market. So 1.25 times 20, that gives you 25% portfolio risk. Now let's crank it up a bit. If he borrows 50% instead, meaning he invests 150% in the market, his expected return jumps to 20% and risk climbs to 30%. And if he goes all in, borrows 100% and invests 200% in the market, his return hits 25% and the risk doubles to 40%. So what's the takeaway? As leverage increases, both risk and return rise proportionally. You can't have one without the other. And the same old formula still holds true. The expected portfolio return equals the risk-free rate plus the extra market return per unit of risk times how much total risk you're taking. Now, take a look at what's up on the screen. That's straight from the FinQuiz Battle Ready summary. Honestly, it's a lifesaver when the exam's around the corner and you need to jog your memory fast. It's designed so you don't just memorize formulas. You visually understand the relationships, R, F, M, how leverage stretches the CML, etc. If you're watching this and want to keep these visuals for revision, check out the Battle Ready summaries in the description. And if you want the full CFA prep system, we've got you covered. Stanley Notes for theory, a question bank, mock exams, and our formula sheet, all designed to lock in exam confidence section by section. All right, let's keep the momentum going. So let's slow things down for a second and get into something fundamental, the kinds of risk that actually matter. Because not all risk is created equal. Some risks you get paid for taking, others not at all. And if you don't get this distinction right, you'll miss one of the most important ideas in all of portfolio theory, and one that the CFA exam loves to test. So let's start simple. When you hold an individual stock, let's say Apple, that investment comes with a bunch of uncertainties. iPhone sales might slow down, supply chain issues might pop up, or maybe new competitors start eating into market share. Those are company-specific things. They affect Apple, but not necessarily the whole market. That kind of risk is called non-systematic risk, or diversifiable risk. It's also known as idiosyncratic risk, the stuff that's specific to one company, one industry, or one event. Now let's contrast that with systematic risk, the one you can't escape. These are things that hit everyone. Rising interest rates, inflation shocks, recessions, global political tension, oil prices, pandemics, the big macro stuff. You can diversify across countries, sectors, and asset classes all you want. But if the global economy takes a downturn, almost everything gets dragged down with it. So in short, total risk equals systematic risk plus non-systematic risk. But here's where it gets really interesting and practical. You don't get extra return for taking non-systematic risk. Let me explain that in plain English. Imagine two investors. One holds a single airline stock. The other holds a diversified ETF with 500 stocks in it. Now, both are exposed to market-wide factors like interest rates and inflation, but only the first guy is also exposed to the risk that one plane crashes or maybe the company's CEO quits suddenly. Now, should the first guy earn more return for that extra company-specific risk? The answer is no, because that kind of risk can be diversified away. All he had to do was hold more stocks. If markets actually paid investors for taking non-systematic risk, everyone would just buy super risky small companies, then diversify afterward, locking in extra returns for risk they no longer had. Sounds great, right? But that can't happen in an efficient market. Prices adjust, and the premium for non-systematic risk disappears. That's why theory says you get rewarded for systematic or market risk only. You don't get rewarded for non-systematic or company-specific risk. So, the smart move? Diversify that idiosyncratic risk away. Hold assets across different industries, countries, and asset classes so that one bad event doesn't blow up your entire portfolio. Let's make it practical. Think of a fund manager at JP Morgan. She's building a global equity fund. If she holds 100 US tech stocks, she's not really diversified. That's still concentrated risk. But if she adds banks, healthcare, energy, and international equities, now her non-systematic risk starts melting away. The only risk that remains is the big market stuff, interest rates, inflation, global growth, the kind she should be compensated for. That's the key difference between professional portfolio construction and just picking stocks. You're not trying to eliminate risk. You're trying to eliminate the wrong kind of risk. All right, so the CFA exam loves to ask this kind of question. Which type of risk is actually priced in the market? And the answer is always the same: systematic risk, and only systematic risk. Now, if they follow up with, well, why not non-systematic risk? Just keep this in mind, because non-systematic risk can be diversified away. That's it. That's the entire logic. Now, if interest rates jump or inflation spikes, every company feels it. Apple, Exxon, McDonald's, even the small cap startups. That's market level uncertainty. You can't diversify that away, so you better get compensated for it. But if one biotech firm fails a drug trial, that's specific to that firm. It's diversifiable. No reason the market should pay you extra for holding that one unlucky stock. All right. So we've talked about what risks exist: systematic versus non-systematic. Now let's talk about how those risks get priced. Because in the end, investing is all about risk and the return you demand for taking it. So think of it this way. When you buy any asset, a stock, a bond, a property, you're really saying, I'll take on this much uncertainty, but only if I get paid for it. That payment is your expected return, and it's basically the market's way of saying thanks for carrying that risk. Now, the key question becomes, which risk are you getting paid for? We just said that non-systematic risk, like company-specific stuff, can be diversified away. So the only type of risk that really deserves a return premium is systematic risk, the one that hits everyone. All right, so now let's move one step further into how returns are actually generated. Because here's the big question every analyst asks. How do we figure out what return an investment should deliver given its level of risk? That's where return generating models come in, folks. Think of them as blueprints, mathematical tools that help us estimate what return a stock or bond should produce based on certain factors. And just like in real life, some blueprints are simple and some look like they were designed by a committee of economists. So let's start with the logic. If you could build the perfect market portfolio, the one that includes every risky asset on earth, you'd need to estimate thousands of returns, volatilities, and hundreds of thousands of correlations. Yeah, good luck with that. Even a portfolio of just 1,000 assets would require nearly 500,000 correlation estimates. That's not analysis. That's a math nightmare. So instead, investors use models to simplify reality. You start with something you already know, say the S&P 500, and you ask, what happens if I add this new asset to my portfolio? Does it improve my return to risk ratio? To answer that, you only need to know how much the new asset moves with the market. That's its systematic risk. And voila, that's exactly where return generating models come in. A return generating model estimates the expected return of a security given its exposure to one or more factors that drive returns. If systematic risk is the only thing that matters, the model uses that one factor, the market. But if you believe other factors also affect returns, you can build a multi-factor model that includes them too. So basically, the more factors you include, the closer you get to reality. But the messier the math becomes. Now, let's talk about the three broad categories you'll see on exam day. And yes, remember the names. First one, macroeconomic factor models. These use big economic drivers like GDP growth, interest rates, inflation, consumer confidence, and employment data. Think of a global asset manager watching inflation rise. that factor directly affects bond prices, equity returns, and even real estate. Now, fundamental factor models. Here, the focus is on company-specific fundamentals: earnings, book-to-market value, cash flow, R&D spending, advertising, patents, the stuff you'd actually see in financial statements. It's how managers like BlackRock or Fidelity evaluate how much a company's fundamentals explain its returns. And then there are statistical factor models. These come from pure data crunching. Analysts run regressions across hundreds of returns and try to find patterns that explain movements, sometimes with no obvious economic reason. And that's where things get funny. There was a study once linking the US stock market's performance to which football conference won the Super Bowl. True story. Data can find factors everywhere, even when they make zero sense economically. That's why CFA Institute and most serious professionals prefer macroeconomic or fundamental models over purely statistical ones. Okay, so let's say you want to model an asset's return. Here's the general idea. Don't worry, we'll keep it human. Expected return on the asset minus the risk-free rate equals the sum of factor loadings times the expected premiums for those factors. Each beta represents how sensitive that asset is to a particular factor. We call that factor loading. If a stock's beta on the market factor is 1.2, it's 20% more volatile than the market. If its beta on inflation is negative 0.5, it tends to drop when inflation spikes. Pretty intuitive once you start thinking in business terms. Now, some of you have heard of the Fama-French model, and yes, it's fair game on the exam. Eugene Fama and Kenneth French came up with the idea that stock returns depend not just on market exposure, but also on size, meaning small versus large companies, and value, like high versus low book-to-market ratios. Later, Mark Carhart added a momentum factor. Stocks that have recently performed well tend to keep doing well for a while. So the four-factor model became the go-to in asset pricing and performance evaluation. If you're ever in an interview and someone mentions Carhart, you'll sound sharp if you can say, "Oh, you mean the Fama-French three-factor model plus momentum." All right, let's zoom back to the basics. The single index model, the simplest return-generating model of them all. This one says the only factor that matters is the market. You've probably seen this one already when we talked about the capital market line. Same idea, just written for an individual security instead of a whole portfolio. What it's really saying is the extra return on a stock over the risk-free rate depends on its beta, how much it moves with the market. If, let's say, beta equals 1.2 and the market's expected excess return is 8%, the stock's expected excess return is 9.6%. That's it. Super clean, super testable. And if you use realized returns instead of expected ones, you can separate total risk into systematic and non-systematic components. So total variance equals market-related variance plus firm-specific variance. That's just the math version of what we said earlier. Total risk equals systematic risk plus non-systematic risk. All right, folks, let's make this thing real for a second. You've been seeing all these equations. Now let's see how it actually plays out in the real world. So the market model, think of it as the real-life version of the single index model. It's basically what analysts use every day when they want to check how a stock moves compared to the overall market. Here's what we do. We grab some historical data, let's say Walmart's daily returns, and line it up against the S&P 500's daily returns. Then we run a simple regression to see the relationship between the two. That regression spits out two key numbers, alpha and beta. Now, suppose the regression gives us alpha, let's say 0.0001 and beta 0.9. Now, what does that really mean? It means that we can predict the Walmart's daily returns, on average, of course, using this little formula. So if the market went up by 1%, you'd expect Walmart to rise about 0.9%. Pretty straightforward, right? But here's the interesting part. Let's say Walmart actually jumped 2% on that same day. Well, 2% is a lot more than the 0.9% the model predicted. That difference, that extra 1.1%, that's what we call abnormal return, or simply alpha. It's the something special that can't be explained just by market movement. Maybe it's because Walmart announced higher than expected earnings or launched some crazy new cost-saving strategy. Whatever the reason, that extra return came from company-specific factors, not the market. And that's what analysts get excited about. They look for those alpha moments, times when a stock moves more than the model says it should, because that's where the real opportunity lies. Spotting performance that isn't just driven by market waves, but by something unique to that company. So remember, folks, alpha is how they separate true skill from just riding the market wave. Now you might be wondering, what's that little e at the end? Well, that's the error term, basically the unpredictable company-specific stuff that can't be explained by the market. So before we wrap up this section, let's talk about how all this actually shows up in real-world investing. Return-generating models aren't just academic formulas. They're the backbone of how analysts build, evaluate, and manage portfolios. First, in portfolio construction, these models help us focus on systematic risk, the risk that really matters, and ignore all that company-specific noise that can be diversified away. It's what lets portfolio managers design diversified portfolios without getting lost in every single stock detail. Second, in performance attribution, analysts use these models to break down returns, separating what came from broad market moves versus what came from individual security selection. So if your portfolio beat the market, you'll know whether it was because of smart stock picks or just a rising tide lifting all boats. And finally, risk management. These models help us identify which risks can actually be diversified out and which ones we're truly stuck with. The market risks we have to be compensated for. In practice, this means managers can spot when they're overexposed to certain factors, like interest rates or inflation, and adjust before it becomes a problem. So yeah, these models, they're used every single day to design portfolios, measure performance, and manage risk in the real world. All right, let's talk about beta, one of those little Greek letters that shows up everywhere in finance. If you're sitting for CFA level 1, you will get a question on this, so let's make sure it sticks. Now, remember back when we introduced the single index model? We said that the return on any asset can be written as its risk-free component plus something that depends on how it moves with the market. That how it moves with the market part, that's beta. It's the covariance between the return on the asset and the market divided by the variance of the market. That's just a fancy way of saying how sensitive is this asset to overall market swings. So if the market sneezes and your stock catches a cold, yeah, that's a high beta stock. Let's make this real. Say the correlation between a stock and the market is 0.7. The stock's volatility is 25% and the market's volatility is 15%. Multiply 0.7 by 0.25 divided by 0.15. You get roughly 1.17. That means this stock moves 17% more than the market. It's a little more dramatic, kind of like a growth tech name reacting faster to good or bad news. Now, if you flip that logic, a beta less than 1 means the stock is calmer than the market. Think utilities, consumer staples, those steady names that don't jump around much. And a beta greater than 1 means it's more volatile, like Tesla, Nvidia, or small cap techs. If beta is 0, that's a risk-free asset. It doesn't move with the market at all. And if beta is negative, that's rare. But it means the asset moves opposite the market. A classic example, insurance. When the market tanks, your insurance claim pays out. So even though it might earn less on average, it protects your portfolio when everything else is down. That's a negative beta payoff. Now, exam-wise, remember this. Beta measures systematic risk, the part you can't diversify away. That's why CAPM, the capital asset pricing model, builds everything around it. So we plug beta right into the CAPM equation. Expected return equals the risk-free rate plus beta times the market risk premium. The higher the beta, the higher the expected return you should demand because you're taking on more systematic risk. Let's crunch a quick example. Suppose the risk-free rate is 3%, the market return is 10%, and Apple's beta is 1.5. Expected return, 3 plus 1.5 times 10 minus 3 equals 13.5%. That's the premium Apple investors expect for taking on extra risk versus T-bills. But what if an analyst thinks Apple's becoming more mature, more like the market, so its beta should be 1.1 instead of 1.5? Now that same formula gives you 10.7%. Lower expected return because the risk is lower. And that's exactly how analysts adjust required returns as companies evolve. Now, just a small warning for your exam. Beta estimation is a bit of an art form. We calculate it from historical data using regression. You plot the stock's returns versus the market's returns and fit a line through those dots. The slope of that line is beta. Short-term data gives you a more current feel, but can be noisy. Long-term data is smoother, but might miss recent changes. So analysts often blend both, using about 3 to 5 years of monthly returns to get a balance estimate. And hey, don't overthink it. On the exam, they'll usually hand you either covariance and variance or correlation and standard deviations. Just remember these quick forms. That's it. No heavy lifting and just plug and play. So if you see a question like, which of the following securities most likely has a beta less than 1? You look for something defensive. If they ask for something negatively correlated with the market, think insurance, gold, or maybe some hedged asset. And remember, beta is about how much an asset amplifies or dampens market movements, not about whether it's risky in isolation. Now, all that stuff you're seeing on screen right now, neatly organized for quick recall. They're all straight from the FinQuiz Battle Ready Summary. If you want to own this topic before exam day, grab the full set of PDFs from the link in the description. We've also got Stanley Notes, mock exams, the FinQuiz question bank, and a complete formula sheet. Everything you need to stay sharp till test day. All right, let's take everything we've built so far, beta, systematic risk, expected return, and plug it into one of the most famous models in finance, the capital asset pricing model, or simply CAPM. At its core, CAPM is an equilibrium model. It says, hey, the only risk that matters is the risk you can't diversify away. That's systematic risk. Everything else, all that company-specific noise, doesn't earn you any extra reward. So here is the CAPM equation. Remember? You've seen this one before. It's expected return equals the risk-free rate plus beta times the market risk premium. So remember what we talked about earlier, the idea that beta basically tells you how much risk you're taking compared to the market. Well, the higher your beta, the higher the return you should expect, because you're taking on more of that market level systematic risk. If your beta's 1, your asset moves right with the market, up when it's up, down when it's down. If it's less than 1, it's a little calmer, kind of like a chill bond fund that doesn't panic when the market swings. And if beta's negative, like say insurance, that's the rebel. It moves in the opposite direction of the market. So yeah, sometimes it can even earn less than the risk-free rate, but it's valuable because it protects you when everything else falls apart. Now picture this. You've got 2 assets. One's a super steady bond fund with a beta of 0.6, and the other's a fast, high-energy tech stock with a beta of 1.4. If the risk-free rate is 3% and the market's expected return is 9%, the bond fund should land around 6.6%, and the tech stock about 11.4%. That right there is CAPM doing its thing. Higher beta, higher expected return. Simple, logical, and yeah, the exam loves this concept. All right, so now that we've seen how CAPM connects risk and return, let's talk about the fine print, the assumptions behind this model. And yeah, I know what you're thinking. Do we really have to memorize these? Yes, you do. Because the CFA exam loves to test which of these assumptions are realistic and which ones are just, well, wishful thinking. So here we go. First off, investors are rational, risk-averse, and utility maximizing. Now, what does that mean in plain English? Basically, we all want the most return for the least amount of risk. No one wakes up saying, you know what? I'd love to take more risk for less return today. So yeah, that's assumption number 1. We're all logical, reasonable human beings. And yes, in real life, that's not always true, especially when markets are hyped or crashing, right? Next, frictionless markets. Yes, the fantasy world where there are no taxes, no transaction cost, and you can borrow or lend at the risk-free rate. Wouldn't that be nice? In real life, there's always some cost, even if it's tiny. But CAPM assumes everything is smooth and free. So, you buy, you sell, you short. No commissions, no bid-ask spreads, no capital gains tax. Pure math paradise. Moving on, single period horizon. Everyone's investing for just one time period. Now that could be 1 year, 6 months, or whatever the analyst defines. But we're all looking at the same time frame. Of course, in the real world, investors have different goals and time horizons. Retirees, traders, students saving for grad school, all different. But for the model, we keep it clean and simple. Then there's homogeneous expectations. Fancy phrase. But all it means is that everyone sees the market the same way. Like if you and I both look at Apple stock, we agree on its risk, expected return, and correlation with the market. Basically, we're all running around with the same spreadsheet in our heads. Yeah, not exactly realistic, but it keeps the math tidy. Next one, infinitely divisible assets. That means you can buy a fraction of anything. Like you don't have to buy a whole stock. You can own 0.0001 shares if you want. In real markets, we're kind of close to that with fractional investing these days. So this one's not too bad. And finally, price takers. No single investor is big enough to move prices. We all just accept whatever the market price is. So unlike Warren Buffett or BlackRock, we're all just small fish swimming in a very big pond. So yeah, that's the assumption set behind CAPM. A clean, rational world where everyone agrees trades for free, and lives happily ever after. Of course, in reality, people get emotional, fees exist, and markets get messy. But the beauty of CAPM is that even with all that mess, it still gives us a really solid way to link risk and return. All right, now let's make this thing visual, because this is where CAPM comes alive. We've got the security market line, or the SML, and this, folks, is basically CAPM on a graph. Picture this. On the horizontal axis, we've got beta, our measure of risk. And on the vertical axis, we've got expected return, what investors hope to earn for taking on that risk. Now imagine a straight line starting from the risk-free rate. That's your intercept, and it is sloping upward. That line is the SML, and the slope of that line, that's the market risk premium, which is E of RM minus RF. So the steeper the line, the higher the reward per unit of risk. Simple idea, right? But this is one of those visuals the CFA Institute loves, because every point on that line represents a fairly priced security. The market says, if you take on this much risk, you should earn this much return. Now, here's where it gets fun. If a stock sits above the line, that means it's undervalued. It's giving you more return for the same risk. That's a hidden gem, the kind of stock analysts drool over. If it's below the line, that means it's overvalued. You're taking on too much risk for too little reward. And if short selling is allowed, you'd short that thing faster than a Wall Street trader on a caffeine rush. In equilibrium, though, all properly priced securities, all well-behaved portfolios, they lie on the SML. Their returns line up perfectly with their risk, and no arbitrage opportunity exists. That's the beautiful, clean CAPM world. Now, quick comparison, because the exam loves to throw this curveball. You've seen the CML, the capital market line. The CML applies to efficient portfolios where all risk is systematic. The SML, on the other hand, applies to any security, efficient or inefficient, because it uses beta, not total standard deviation. So remember this line for your exam. CML uses total risk. SML uses systematic risk. They look similar on paper, but they tell different stories. If you ever see individual security in a question, it's SML. If it's efficient portfolio, it's CML. That's the kind of small detail that earns you easy marks. All right, so now let's clear up a confusion that almost every candidate has at some point, the difference between the CAL and the CML. Now, the CAL can use any risky portfolio, but once that risky portfolio becomes the market portfolio, it turns into the CML. Think of it this way. CAL is any combo of a risk-free asset and a risky portfolio, but when that risky portfolio is the market, that special CAL becomes the CML. So the capital allocation line, CAL, and the capital market line, CML, apply only to efficient portfolios, those that are perfectly diversified. Why? Because both of these use total risk, the full standard deviation, to measure volatility. But the security market line, SML, that's a whole different story. The SML applies to any security, efficient or not, because it's based on systematic risk. That's your beta, not total risk. Now let's talk about portfolios, because this is where CAPM really starts to work in real life. The expected return on a portfolio follows the same CAPM structure. It's the risk-free rate plus the portfolio beta multiplied by the market risk premium. Here, beta P, the portfolio beta, is just the weighted average of all the betas of the individual assets in your portfolio. So if you got a mix of, say, Apple, Exxon, and some bonds, each with different betas, your portfolio beta reflects that combination, weighted by how much you've invested in each. In short, the portfolio's expected return is nothing mystical. It's just the weighted return based on how risky your assets are relative to the market. And that's what makes CAPM so elegant. One equation ties it all together, from a single stock to a multi-asset portfolio. All right, so let's wrap this up with something really practical, because this is where CAPM stops being theory and starts becoming a tool you'll actually use in the real world. We're talking about the applications of the CAPM, where it shows up in finance, in business, and even in corporate boardrooms when big money decisions are being made. Now, remember, the whole point of CAPM is to tell us what kind of return an investor should expect for a given level of systematic risk. So yeah, in real life, the actual return may bounce around a bit. Markets are messy, right? But CAPM gives you the benchmark. It tells you, given this level of risk, here's what you deserve to earn. Let's start with capital budgeting. This is where the CAPM really earns its keep. Picture yourself working at a big firm like Unilever, the CFOs deciding whether to launch a new product line. The big question, what return do we need to make this project worth it? That's where the CAPM steps in. It helps estimate the project's required rate of return based on its risk. If the project clears that hurdle rate, it's a go. If not, it's off the table. So yeah, in real business life, the CAPM isn't theory. It's how big companies make million-dollar decisions every single day. Now let's talk about valuation, where every investor lives. When you're trying to figure out if a stock is overpriced or a bargain, the CAPM helps you estimate what return that stock should deliver for the level of risk it carries. If the stock's expected return is higher than what the CAPM suggests, it's likely undervalued, a good deal. If it's lower, it's probably overpriced. So that's how analysts, portfolio managers, and investors everywhere use the CAPM to decide what's worth buying or selling. And finally, performance evaluation. Basically, how we judge if a fund manager is doing their job. You compare what the portfolio actually earned to what the CAPM says it should have earned for that level of risk. If the manager beats that benchmark, they've added value. That's called alpha. If they fall short, they've underperformed for the risk taken. That's how pension funds, hedge funds, and even private investors measure skill, using the CAPM as the yardstick for fair performance. All right, folks, so now that we've seen how powerful the CAPM can be, let's take a step back and talk about what's beyond it. Because as with most models in finance, the CAPM isn't perfect. It's elegant, yes, but it comes with its fair share of assumptions and blind spots. Let's start with the limitations, because understanding where the model struggles actually helps you use it better in real life. So first up, the CAPM is a single factor model. That means it only looks at one thing, systematic risk or beta. It assumes that beta alone explains why some assets earn more than others. But in the real world, we know there are a bunch of other things that move prices, like company size, value versus growth, or even investor sentiment. And then there's the single period assumption. CAPM basically looks at investing like it's a one-period game. You invest today, you earn at the end of the period, done. But life doesn't work that way. Investors think in years, not snapshots. Portfolios change, interest rates shift, markets evolve, and the single period lens doesn't quite capture that dynamic reality. Now, when you actually try to apply the model, that's where more issues pop up. For starters, the market portfolio that CAPM talks about, the one that includes all assets in the economy, doesn't actually exist. It would have to include everything: stocks, bonds, real estate, human capital, art, gold, even your grandma's antique watch. So in practice, we use a proxy, like the S&P 500. But different analysts use different proxies, and that means different results, which technically violates CAPM's clean universal logic. Then there's the issue of estimating beta. We usually calculate it using historical data, but markets evolve, companies evolve, and past data may not reflect the present. A company that was low beta a few years ago might have become a high-risk growth story today. And finally, even after all that, CAPM just isn't a great predictor of returns. Empirical research shows that actual returns often don't line up neatly with what CAPM predicts. So yeah, it gives a nice theoretical framework, but it's not the holy grail for forecasting. All right, now let's move past the CAPM. Because let's be honest, finance didn't just stop there. Once the theory hit the real world, people started asking, wait a minute, can one factor, just beta, really explain everything? And that's where Stephen Ross steps in with something called the Arbitrage Pricing Theory, or APT. His idea was kind of revolutionary. He said, why limit ourselves to one factor when markets clearly move on many things at once? Think about it. Inflation, GDP growth, oil prices, investor sentiment, interest rates. Markets react to all of it. So APT says returns can be explained by several risk factors, not just one. Sounds great, right? It's flexible, elegant, and way more realistic. But here's the catch. It doesn't tell you which factors to use. It's like saying, yeah, there are multiple drivers, but not giving you the map. So in practice, most analysts still find CAPM easier to apply day to day. Now, on the more practical side, enter the Fama-French Carhart four-factor model. This one took over Wall Street. It's what most quant teams and portfolio managers rely on today. Fama and French first added two new ideas to CAPM: size and value. They noticed that small cap stocks and value stocks consistently beat large cap and growth ones over time. Then Carhart came along and said, hold up, there's one more thing: momentum. Stocks that have been rising lately tend to keep rising, at least for a while. So this model says market risk matters, but so do size, value, and momentum. It's like CAPM got a real world upgrade. Now it talks about what actually moves money in markets. So if you're wondering how this plays out, just look at how hedge funds and asset managers work. They'll say things like, our fund has small cap exposure, or we're tilted toward value and momentum. That language? Straight out of Fama-French Carhart. It's not flawless. It's not based on a perfect theory of equilibrium like CAPM, but it works. It explains real data, real returns, real portfolios. So yeah, CAPM was the starting line, not the finish line. It gave us the vocabulary of risk and return, but models like APT and Fama-French helped translate that theory into the messy, unpredictable reality of financial markets. By the way, everything you're seeing here, from CAPM to Fama-French, is summarized neatly in your FinQuiz Battle Ready summaries. Now, what they do is they take all this theory and strip it down to what you'll actually need on exam day. If you're serious about scoring high, check out our Stanley Notes, formula sheets, and question bank as well. All linked below. They'll turn your prep from I kind of get it to I own this. All right, folks, let's wrap up this module with something that's super practical: performance appraisal. Because honestly, it's one thing to manage a portfolio, but it's another thing to prove you did a good job. Performance evaluation basically means measuring how well an investment or portfolio manager performed, not just in absolute terms, but relative to the risk taken. And that's exactly what we're doing here, comparing the actual return of a portfolio with what the CAPM says it should have earned for the amount of risk involved. Let's break down the most common tools professionals use to do that. Now, these are the classics. We will cover the Sharpe Ratio, Treynor Ratio, M-squared, and Jensen's alpha. Okay, so first up, the Sharpe Ratio, kinda the all-rounder, also called the reward to variability ratio. So this one measures the excess return per unit of total risk. That's total risk, not just market or systematic risk. Think of it as how much reward am I getting for every unit of volatility I'm taking on. Higher Sharpe equals better performance. Simple. So if portfolio A has a higher Sharpe ratio than portfolio B, it means A gave more return for every bit of total risk it carried. The Sharpe ratio is great for comparing portfolios that represent a person's entire investment, like when someone's invested in just one mutual fund. But there's a catch. It uses total risk, which includes both systematic and unsystematic risk. So for diversified portfolios, it's fine. But if the portfolio isn't diversified, it can be a little misleading. It's quick, intuitive, and every CFA exam loves to ask about it. So keep that one locked in. Now, if Sharpe Ratio looks at total risk, the Treynor Ratio zooms in on systematic risk or beta. So this one answers, how much excess return did I earn per unit of market risk? In other words, how well did the portfolio do given the risk that couldn't be diversified away? Treynor is perfect for well-diversified portfolios, where unsystematic risk doesn't matter anymore. The higher the ratio, the better the manager performed relative to market risk. And this is important, it doesn't work for portfolios with negative beta values because that would flip the math on its head. So yeah, Sharpe's for total risk, Treynor's for systematic risk, easy distinction. Next up, M-squared or M-squared measure. It's Sharpe in disguise. If you've ever wondered what the Sharpe ratio feels like in percentage terms, this is it. What it does is take your portfolio, lever it up or down until it matches the market's risk level, and then compares the adjusted return. So if M-squared is positive, boom, your portfolio outperformed the market on a risk-adjusted basis. If it's negative, underperformed, and if it's zero, you basically match the market. It's just another way of saying how much better or worse did we do than the market after accounting for risk. And the cool thing is it converts the Sharpe ratio into something more intuitive, an actual return number. And finally, we've got Jensen's alpha, sometimes just called alpha. And this one's the ultimate test of manager skill, kinda manager's report card. It tells you how much the portfolio earned above what the CAPM predicted given its level of beta. So if alpha is positive, the manager outperformed, added real value. If it's negative, they underperformed, didn't earn enough for the risk taken. So in plain English, Jensen's alpha shows whether active management was worth paying for. A fund with a 5% alpha crushed the market by 5% on a risk-adjusted basis. And that's what every portfolio manager dreams of showing on their performance sheet. All right, before we move to the next section, let's make these 4 performance measures super easy to remember. Think of it like this. The Sharpe ratio tells you how much return you're getting for every bit of total risk you take. It's like your all-round scorecard, perfect if you're managing someone's entire portfolio, since it includes both market and company-specific risk. Now, if you're already well-diversified and only care about market risk, then the Treynor ratio is your go-to. It zooms in on systematic risk, or beta. Basically, how much return you're earning per unit of market exposure. Then there's M squared, which is basically Sharpe in plain English. It says, if my portfolio had the same risk as the market, how much better or worse would I have done? So instead of a decimal like 0.8, it gives you a percentage you can actually feel, like I outperformed by 2%. And finally, Jensen's alpha, the one portfolio managers love to show off. It measures how much you beat or lag behind what CAPM predicted based on your beta. Positive alpha, you added real value. Negative, you didn't earn enough for the risk you took. So Sharpe is about total risk. Treynor focuses on market risk. M squared turns Sharpe into a percentage, and alpha is your proof of skill. Together, they tell the whole story, not just who made money, but who made it efficiently. All right, folks, we're now stepping into one of the most practical parts of this whole topic, how CAPM actually helps you build a portfolio in the real world. Up until now, we've been talking about theory, risk, return, beta, alpha, and all those formulas. But this is where it all comes together, portfolio construction and security selection. So let's dive in. Okay, so first, the security characteristic line, or SCL, where theory meets data. It's basically a fancy way of saying, let's see how a stock's returns move compared to the market. You take the excess return of a stock, that's RI minus RF, and you plot it against the excess return of the market, RM minus RF. Run a regression line through it, and boom, that line is your SCL. Now here's the fun part. The slope of that line is your beta. It shows how sensitive the stock is to market movements. The intercept is alpha, also known as Jensen's alpha. It tells you whether the stock's return is higher or lower than what CAPM predicts. So when analysts talk about alpha generation, this is literally what they mean. That little extra bit of return beyond what the market model expects. Now, once you've got alpha and beta for different securities, the next question is, which one should I hold? Here's where CAPM becomes your decision filter. If your analysis shows that a security's expected return is higher than the CAPM predicted return, it's undervalued, meaning it's offering more return than its risk justifies. That's your green light. Buy it or overweight it in your portfolio. If the opposite happens, expected return is lower than what CAPM suggests, the stock's overvalued. That's your red light. Sell it or short it if you can. In CFA terms, a positive alpha means the stock's expected to outperform the market on a risk-adjusted basis, while a negative alpha means it's expected to underperform. And here's a quick example. Imagine you're analyzing Apple and another smaller tech stock. Both have the same beta, but your return estimate for the smaller stock is higher than CAPM predicts. That's alpha. And it means the market might be mispricing that smaller company, so you tilt your portfolio slightly toward it. Now that you've figured out which securities are over or undervalued, it's time to actually build the portfolio. You can think of this process in 3 steps. If it's positive alpha, add that security to your portfolio, folks, because it's undervalued. If it's negative alpha, remove it or short sell, it's overvalued. So you need to add just your investment weights. The amount you put into each security should correspond to the size of its alpha and its risk. That's right. Securities with higher alpha get more weight, and those with higher non-systematic risk or company-specific risk get less weight. Why? Because the more idiosyncratic risk you take, the less consistent your alpha will be. Now, here's something students often miss in the exam. Even a correctly priced security can have a non-zero alpha. It just means that based on current market data, that's its fair excess return, not necessarily a mispricing. Also, the total weight of the non-market securities you include in your portfolio, those outside the index, should be proportional to their alpha to risk ratio. That's alpha I divided by sigma I squared. This keeps your portfolio balanced and ensures that each position contributes efficiently to your overall performance. And this leads to one of the most important ratios you'll see here, the information ratio. It measures alpha relative to the non-systematic risk of the security, basically how much extra return you're getting for each unit of unique, diversifiable risk you're taking. Higher information ratio equals better performance. This is the kind of ratio active fund managers love to brag about because it directly reflects their skill in stock picking, not just their exposure to the market. So here's the big takeaway. CAPM doesn't just explain how risk and return are connected. It gives you a systematic way to build and fine-tune portfolios, identify undervalued opportunities, and quantify manager performance. When you're seeing alpha, beta, or the security characteristic line in practice, that's CAPM quietly working behind the scenes. So yeah, that wraps up how CAPM actually comes alive in portfolio construction. It's not just a theory you memorize for the exam. It's the framework that helps real investors spot undervalued stocks, balance risk, and build smarter portfolios. When you hear analysts talk about alpha, beta, or risk-adjusted performance, this is exactly what they're doing behind the scenes. And honestly, once you get the hang of it, it's kind of cool. CAPM gives you a logic for every investment move. Add what's undervalued, trim what's overhyped, and always weigh return against risk. That's portfolio management in a nutshell. Now, what we've covered here is the backbone of modern investing, how risk connects to return, how portfolios are built, and how performance is judged. You've seen how beta, alpha, and CAPM all fit together, not as isolated formulas, but as tools professionals use every single day to make real decisions. At this stage, it's about clarity, not memorization. When you see a question on the exam, think like a portfolio manager. What's the risk? What's the reward? What makes sense? That mindset will carry you further than any shortcut ever could. So, when you open that CFA exam, don't just memorize. Picture the logic behind each question. That's what separates candidates from future charter holders. And just a reminder, everything you saw here today, the visuals, the summaries, the examples, all of it comes straight from our FinQuiz Battle Ready summaries. If you haven't tried them yet, just go to Google and type FinQuiz Battle Ready summaries and download the free sample. It'll make your revision 10 times sharper. And when you pair those summaries with our Stanley Notes, formula sheets, and mock exams, you're not just preparing, you're training your mind to think the way the exam wants you to think. That's how you walk into exam day confident instead of guessing. All right, good luck, take care of yourself, and I'll see you in the next lecture.